Bitcoiners, welcome to another episode of Fed Watch. I'm here with Ansel, and man, I'm just blown away by the caliber of this conversation. We just sat down with Dylan LeClair, 20-year-old stud on the Bitcoin Magazine team, and we talked the long-term debt cycle, we talked Bitcoin, we talked, what we can expect from the global macro economy in the next few years. Ansel, what was your take on this conversation?
Oh, it was great. He is, like you said, very young. I don't think that's super important. What I think is important is that he is new to economics and he got into economics through Bitcoin and now he gets it. He totally gets it. And he's starting to make some insights and he's starting to write some good content out there. And I think that this is the type of person we need in Bitcoin. And yeah, I had a lot of fun talking to him.
Yeah, it is really impressive to see, Dylan coming into Bitcoin and economics with a very open mind and really fast tracking. You could call it like 35 years of education and experience in 2 years. And, me personally, like Bitcoin has been the biggest leverage point of my personal finance education and my education in macro. And, seeing, someone younger take it to the next level of understanding it's so bullish, and it makes me optimistic for the youth growing up in a Bitcoin world.
Yeah, we did get into some of the inflation deflation debate a little bit. You pushed back a little bit on him, and I think that he has a little bit further to go with kind of connecting some of those dots. But no, I thought it was brilliant conversation.
Awesome. Well, I know you guys are going to enjoy this one, but before we get into it, I want to tell you guys about Bitcoin 2021, the biggest, baddest, and best Bitcoin conference in history. It's going to be over 10,000 people in Miami. We have over 10,000 tickets sold, over 1,500 whale night tickets sold. This event is going to be a monster. 2 after party venues just to fit all of you crazy rowdy Bitcoiners in there. And the speaker list is absolutely off the charts. Every single Bitcoiner, the lovers and the haters of the conference, are going to be in Miami. And I think that just shows, how this is the Schelling point for Bitcoin energy in the world this year and in June. And in America, Miami, the city, is one of the greatest Schelling points of freedom. So it is really beautiful to see this amazing event unfold. It is really exciting to get to meet Ansel, my co-host and a long-term mentor of mine in person. And I'm just so hyped to be there. You all can be there as well. Go to b.tc/conference and go get your ticket today. You can get your ticket at a 10% discount if you use promo code Satoshi. Tickets are quite expensive. As I said, we're pretty much sold out as it is. So if you want to get your ticket at this point, you really got to pay for it. But you can save $400 in addition to that 10% if you pay with Bitcoin. We do not want your fiat. We want sats, and we're willing to give quite the steep discount to get those sats. On top of that, we're making it as easy as possible for you, the listener and future attendee, to get that discount, paying with sats, us receiving sats, but you actually only spending fiat. The way we do that is with MoonPay. MoonPay is one of the sponsors of the conference, and they have implemented their widget into our tickets page. So you can take your debit card, you can run it, or your credit card, and you can run it on MoonPay. You can even use Apple Pay, Google Pay, any of those. You can run it on MoonPay, spend your fiat, send that Bitcoin to us, and you get a Bitcoin 2021 ticket at a significant discount. So y'all, there is no reason not to get that cheap BTC ticket. There's no reason not to pay us in BTC, and there's no reason not to use MoonPay because they're going to be giving you that discounted ticket for free. They're not even going to charge you for that transaction when you use the widget on the b.tc/conference website. That's enough shilling from me. Let's get into this podcast. And I am just so excited about this conversation with Dylan LeClair. Bitcoiners, welcome back to another episode of Fed Watch. I'm sitting here with Ansel, and we have another Bitcoin Magazine stud on the show, my guy, Dylan LeClair. Welcome to Fed Watch.
Thanks for having me on, guys. Happy to come on.
So, Dylan, you've been doing some fantastic work for Bitcoin Magazine and just in the Bitcoin space in general. I think your kind of profile has blown up on Bitcoin Twitter, and people have really started to get excited about the content and work that you're putting out. And it seems like the catalyst for that was this article that you published a couple weeks ago on Bitcoin Magazine, the end of the long-term debt cycle and Bitcoin. I thought it was an absolutely fantastic article. And just kind of seeing you put it together from backstage and then all the way to the actual production of it. It was really, really amazing to see. I guess why don't we just start off the show by introducing yourself, maybe talk a little bit about where you came from and how you got into Bitcoin, and then we can talk about this article.
Yeah, sweet. So I kind of stumbled upon Bitcoin about 2 years ago, maybe a little bit longer than that. Just kind of was trying to figure it out. I've always been a numbers guy, but I figured finance was kind of the way that I was going to go. So I started reading a lot of like value investing books and frameworks, and just trying to figure out like markets in general, not like Bitcoin or crypto or whatnot. And so I did a lot of reading. I read like The Intelligent Investor and like a bunch of other stuff. And I was listening to a lot of podcasts with, especially like Preston's podcast. It's great. And he started digging a little bit into like macro frameworks and whatnot. And it took me a little bit, but what I came to the conclusion of like after a short while was that everything was kind of being driven, equities, real estate, Bitcoin. As I started to dig into it, everything is kind of being driven by this like macro landscape, and central bank liquidity and all this stuff, where like individual companies, I mean, you can stock pick all day, but this big picture is what really matters. So I did, I hopped on Twitter and was just kind of lurking for a while, learning. I read a lot. I read this piece that I just wrote. Was inspired because I read Ray Dalio's Principles for Navigating Big Debt Crises, and he has a bunch of case studies and archetypes and all that, and it's really, really good. There's also a 30-minute video called How the Economic Machine Works, which I think everyone should go watch. It's really fantastic. So yeah, that's kind of like the macro landscape, and then with regards to Bitcoin, I think everyone has their own rabbit hole journey, but that's happened for me, and I've kind of been obsessed with it for the last year or two, especially. So, and now I'm here. So.
Yeah. So, I mean, I feel like you've done a lot of research. Maybe you had the time to do the research, but your kind of understanding of the big picture and macro is really, really well formed. Can you kind of talk a little bit about like maybe like how you got to that point mentally in trying to like understand, what is happening? Because I mean, even 50-year-olds managing millions and millions of dollars don't seem to kind of have a grasp of the big picture, like, what you're kind of like articulating in this and other content that you're putting out.
Yeah, I think just like one of my best attributes is just like kind of figuring out who knows what they're talking about and who doesn't, or like, I guess like, yeah, just like, cycling or filtering out like noise from signal. And so Twitter and just like, I guess like the internet itself is such a great resource, and everything's out there for free. And I'm just a naturally like, very curious person. So I just, there's this infinite rabbit hole in Bitcoin, but really, in anything, investing or any subject field. So I really just kind of dug deep and trying to understand what's happening with rates and central banks and the dollar and these cycles and like why a recession happens or why there's an expansion. Like I think a lot of people just kind of like brush it off. Like there is just these things happen, and especially like the politicians, it's always like about keeping it to the lowest common denominator, right? Like there's never any like, oh, the financial crisis happened because of, and it's just a one sentence response. But a lot of these things are very systematic. So I just was, naturally really curious, and tried to get to the bottom of things, which has led me to where I'm at now and putting these things together to try to formulate my thoughts.
Okay, and my last question before we get into the long-term and short-term debt cycles, but like, what about Bitcoin kind of caught your eye, right? Like, you know, I feel like Bitcoin is like this big idea. Yeah, a lot of young people are getting into it, but personally for you, like when you kind of going on this journey, discovered Bitcoin, can you talk about like, your, I guess your relationship with Bitcoin and how it's evolved?
Yeah, so I was aware of like, and this is like this sounds pretty cringe, but like I was aware of like cryptocurrencies in 2017 when I had some friends that were kind of speculating or whatnot. And so as I turned 18, I decided like, hey, I'm gonna start, making my money work for me. And so I started to do a little bit of digging. And like I said, I was present on Twitter, and luckily I kind of found the maximalist crowd pretty early. So I did some reading. Like I read like the bullish case for Bitcoin and the Bitcoin Standard, and found like this niche like Austrian economics rabbit hole that's like not many people ever dig into, and about like monetary competition and the history of money and stuff that's like that you're not taught in a finance 101 course or econ 101, which was like up until last year. I was studying economics in college for a year, and it was Keynesian economics. So none of the stuff you learn. And it really just kind of challenged a lot of preconceived notions that I had. But being an 18, 19-year-old, I didn't have a lifetime of belief and I guess like faith in any incumbent system. I didn't even know what I didn't know. So I kind of had an open mind to something. And Bitcoin, when you approach it from just a first principle standpoint, it makes a lot of sense. And whereas, the incumbent system in a lot of ways doesn't. So yeah, I think that's like the concise answer.
Well, I have a question regarding Bitcoin Magazine. I think it's really great that Bitcoin Magazine is open door for really great young new content producers. It's almost like a team that has these walk-on athletes. That they can always tap into the people that came up on their content and now are producing content. I think that's great. What has your experience been with Bitcoin Magazine specifically?
And phenomenal. Yeah. I mean, I think that's a great way to describe it. Like, I'm a walk-on athlete, and CK recruited me from, like the back of a gym that no one else was watching. Yeah, it's awesome. I think the Bitcoin Magazine is a great platform just for anybody that wants to share their thoughts about Bitcoin, or, anything like regarding sovereignty or economics, or, privacy or free speech in the digital age, like all this stuff. We want to be that platform, and up until recently, and I still am helping out there. Like I was really, my main focus was like helping people, like outside contributors, publish content, which is kind of how I got my start. It wasn't like I didn't start doing full on content. And so, yeah, I think it's great that we just, there's just this hive mind of people around the world that are passionate about this and are, just want to find truth. And it's a really beautiful thing, just a market of ideas.
All right, jumping into the article then you start off by talking about the cyclicality or cyclicity of debt. So can you explain like short-term versus long-term debt cycles? Like this would be like fit into a Ray Dalio framework, right?
Yeah. And that's kind of what I try to do in the piece is I took his his first book. It's in a series, The Principles for Navigating Big Debt Crises. I took his first book, and I tried to break it down and use a lot of the concepts that he articulated. So the cyclicity of debt is like, in the most basic sense, debt, when you're borrowing from a lender, but you're also borrowing from your future self. You're borrowing from your productivity, and if that debt's used to increase your income or your productivity, it's a good thing, and you have an increased ability to pay it back in the future. But if it doesn't, if that debt is used for consumption or just malinvestment, now you're basically, you have a contract where you have to sell away your future productivity and output. And so this is true at like an individual level as well as like a macroeconomic level. And so naturally, because debt is cyclical, you see these large cycles over multi-year, multi-decade timeframes, And that can kind of be seen with like interest rates over the short and long term. So like, I guess the short-term debt cycle would be what most people think of as like the boom and bust cycle or the business cycle. And it's like, about every 10 years, at least recently. And it's basically that credit is used to finance investment, consumption, and all this stuff across an economy. Our monetary system is a debt-based monetary system. Money is created and destroyed through debt. And so when this, like the lending naturally, it's used for productive investment, but there is speculative activity that occurs. There is now investment, and over time, over years, over decades, the debt builds up, and there has to be, I guess, there's an upswing and there has to be a downswing, and so the debt has to be paid back. And this is, on a decade time frame or a short-term time frame. That's like the short-term debt cycle. And you can see, if you just look at the interest rate chart, there's these peaks and troughs in short-term rates. And I have that later in the piece. It's like from 2000 to 2006, and then 2008, and then just recently in 2020. And over time, these cycles, especially since 1981, it's just basically lower lows in interest rates. Whereas with every cycle, with every boom and bust, with every new expansion in credit, there's more debt in the system, and I guess new sectors in the economy are more over indebted than they've ever become, which makes it that much harder. Which is why rates continue to go lower and lower and lower. And when you get to the zero lower bound, that basically marks. Well, I mean, there's not too much precedent here, but basically marks the end of the long-term debt cycle.
Yeah, I think the short-term one people kind of understand is the business cycle. That one makes sense, but the long-term one is really hard for humans with our shorter time lifespans or whatever of say 70, 80 years. That's about how long one of these long-term debt cycles will happen. And so no one really alive or active in the market today was active in the market back in the 30s, say. So it's, we have this, I don't know, in a company you call like institutional knowledge. I don't know what you would call it like in a market. The market-based knowledge is gone by that time that comes around. What I think is really interesting about this cycle in particular, though, is that we are on a pure credit-based system. There is no gold backing it up. So I do think that, I don't know, we're in uncharted waters. I don't know even where we would go back in history to see something that correlated to this, where there is pure credit-based money.
Yeah.
Do you have any idea on that?
In the 30s, like you nailed it. In the 30s, or after the Great Depression, that was basically the end of the long-term debt cycle there, and countries across the world basically all hit the zero lower bound, and the way that they devalued out of it, the way that they, I guess, escaped the debt crises was they devalued against gold. So there was Executive Order 6102. They took everybody's gold, and then they immediately revalued it higher, which is essentially just lowering the debt burden in real terms. And so that basically allowed them to get out of it in a real basis. And then there was, the Bretton Woods agreement in 1944. But now, it's pure credit, and the more debt, that builds in the system, the less likelihood that it's ever going to be paid back. And so they have to continue to pump in liquidity, and there's going to continue to be these just reinflations, and then these huge deleveraging events, which I don't think are going to go away. And I think it's going to be kind of rocky the whole way down or up, I guess.
Yeah, one of the things that I just think about all the time is that in the past, when we had commodity money, there was some backstop to the deflationary spiral, right? That when the bad debts would get liquidated, it would eventually stop at the backing, the gold. But today there is no backing, so it technically could go to zero money supply, and that's extreme. It's a different scenario, because if you were a central banker, say in the 30s, then that, okay, well, gold has our back.
Yeah.
But today you can't say that. And so they're extremely scared. And that's why we see the same bailouts. That's why they continue to do the QE. They continue to do all this stuff because they can't let it reset.
Yeah, they don't have a choice. Like,
Yeah.
And that's the thing, is that with the credit-based system, everything's just basically a claim, and the whole system is just kind of like levered IOUs on top of each other. And so when there is these deflationary deleveragings, it's kind of like the Brent Johnson thesis is like, the like being bullish on the dollar and the Dixie against all these other currencies. It's that there's so much dollar debt around the world, and especially offshore, which I didn't really even mention in the piece. And there's just not enough like baseline dollars. There's not enough. The system's basically insolvent, and so there's going to be these times when the game of musical chairs ends, and everybody's scrambling to get these dollars, and the system's so over indebted that there isn't enough, and it's just this spiral on the way down. And as a central banker, you don't have really any choice besides to continue or attempt to kick the can. And so in this event, and Greg Foss, who you guys had on, I believe, he has like this credit default swap thesis where basically saying in these deflationary deleveragings, the IOUs you have and the claims on purchasing power and the assets that you think you have, well, if all the money is destroyed, well, you don't really have anything. So you want to have something that has no counterparty risk, that's liquid, that's global. And there's really only one asset that you can hold in today's world. You can hold gold, but I don't really know many people that prefer a monetary metal in the digital age, which is where Bitcoin comes in, and is really just the perfect solution to all of this madness.
Excellent. Christian, do you got something, or you want me to keep rolling?
Keep it rolling, guys.
All right. So then in the piece, you go into the monetary policy responses, like we were just talking, kicking the can down the road and all that. So interest rates, QE, stimulus. Where do you want to start? What's your favorite?
Yeah, I mean, I think it's just it's kind of like an order, right? So like central banks, as long as they have interest rates to play with, they're happy to do that, and they can kind of manage these credit cycles. Like I think the fiat monetary system and just like pure credit, no commodity backing, no gold back, it was doomed to fail from the start. But in the 70s, there was this kind of inflationary period, and starting from and then in 81, rates at 20%, with Volcker coming in and raising everything up. Basically, they had a lot of room to play with. They had this huge lever that they could continue to, if the inflation ran hot, they could raise rates. If the economy needed a kickstart, they could lower rates. And there was still a lot of room to, I guess, play around. Now, over the course of a bunch of short-term debt cycles, rates have made their way to the zero lower bound, where we hit it in 08. Now, after 12 years almost, they couldn't even get rates to 3%. And so, yeah, that's kind of where QE has to come in, because there is no more room for the central banks to come in and stimulate. So, yeah, I don't. Do you want me to just go through it, or do you want to ask questions on that, or?
Well, really not in charge of interest rates. They're in charge of the Fed funds rate, I guess you could say. But there's been studies done where they so Greenspan lowered the Fed funds rate by 0.5% or 50 basis points. Let's watch what happens with the FOMC or the open market operations. And they really didn't do anything. All they did was they talked it down 50 basis points or talked it up 50 basis points. There was no actual repo or reverse repo going on to push the interest rate up and down. And now it's to the point where they can try to talk it up. Like you said, they couldn't even get over 3% because once they got up that high, their words didn't matter. And so then we had a flash crash basically. So I don't know. Do you want to talk about that? Do you think that they are in charge of the interest rates, or are they kind of jawboning it higher and lower?
I think, there's definitely, especially recently, it's a lot of jawboning. Like the Fed, I mean, they ultimately like are in control. And if the Fed, raise rates tomorrow to 2%, everything would tank. So that they do have, I guess, a big red button where they ultimately are in control of this monetary and financial system. But yeah, I think while the market kind of, is the one it's pushing around the Fed, at least over the last decade or two, right? Like Powell, they've consistently changed course. Both the Fed, the ECB, the Bank of Japan, even. I mean, they say one thing, and the markets tank, and really, basically kind of challenge them and say, all right, well, and a lot of times they have to reverse course. So yeah, I think they're going to continue to do a bunch of QE. They're going to continue to talk about like bond yields and short and long term rates. But I think the kind of the curtain over everybody's eyes about inflation and who's signing up for these long dated contracts that are promising a nominal 2% yield. I don't think that lasts for 30 years or whatever the duration is.
I think that the point that you just made is maybe where Ansel and I kind of disagree with the concept that you're pushing. But generally speaking, like, I would push back and say that the Fed and no other central bank actually controls the system. Like, this is a free market system. It's a shitty, opaque free market system that has a bunch of areas for manipulation. But ultimately, like, they are not in control of the global economy. The global economy is way too complicated of a system for them to grok and for them to, manage in any reasonable way, right? So really what they're doing is they're just like, they're blind, they're looking around, they're feeling around, and they're just pulling on shit. And they're doing impression management, like you mentioned, job owning it. They're trying to get people to believe that they control it. They're trying to get people to, act in the way that they are forecasting, right? But ultimately, the actual levers aren't there, right? And when they do QE, when they do stimulus, what they're doing is they're just fucking with the natural orders of things. They're destroying supply chains. They're just like, effectively creating chaos. So I guess, what do you make of that take?
Yeah, I think there's definitely some truth to the fact that markets are like the tail that's wagging the dog. Like the Fed is, or all these central banks. I mean, they're the ones that are setting rates, but markets, and the credit markets, the bond markets are really in charge. If the market starts to sniff out that inflation isn't 2% or 3%, and yields start spiking, like the Fed could buy up the entire bond market, but they don't want to. And same on the way down. So I do kind of agree that there's an illusion of control, but especially as rates have been pushed lower and lower and debts continue to build, the markets are in control, and the Fed and all the central banks and central bankers are really just kind of in damage control.
What's your take on the stimulus then? So that's the monetary policy. What about the fiscal policy side? What did you write in your piece there?
Yeah, so the fiscal policy, and it's like, I guess today it would be called like maybe modern monetary theory. The fact that fiscal can just be financed by central banks buying up the debt. That's kind of in the it's kind of a blend of the second and third forms of monetary policy that Dalio outlined, and that's just because over the course of these long-term debt cycles, wealth becomes kind of polarized, and debt and then insolvencies build. So I guess all of this leverage and all of it goes onto the government balance sheets, and they just decide, all right, well, we're just going to just start throwing money. And so these are, in the form of welfare programs, I guess, like stimulus checks, infrastructure programs. They can be really whatever they want to call it, but it's essentially just getting money out into the system and into people's hands because they don't really have any, especially the middle to lower class.
Is this what we're seeing today?
Yeah. I mean, the talks of more and more stimulus and every few months, another trillion here, another, like, I mean, people are just desensitized to a $1 trillion stimulus package without even understanding like how much money $1 trillion is.
That's half of Apple. That's Microsoft,
I mean,
just like
12
that.
zeros. Yeah, it's insane. And so they have to, if there's not ever more stimulus and liquidity, especially in the markets, especially now that, you know, the entire, like, all of America, or really the world's savings accounts, people aren't saving in the currency. They're saving in the bond markets, the stock markets. They're saving in their pensions, right? Like, people's retirements are the equity in their house, their real estate. It's stock market indexes. It's all passive flows. And so if they stop doing, you know, these Congress stimulus packages, if they stop pumping liquidity into the system, both on the fiscal side and the monetary side, there's going to be a credit contraction. And once it gets going, like we talked about earlier, basically it goes to zero if they don't intervene. Like, money is destroyed, and there's so many obligations and promises in the system, and there's not even close to enough money to, I guess, you know, to make up for all of those obligations. And it's this downward reinforcing spiral. And so yeah, they're really trapped. But, you know, the policymakers and all that want to, you know, pretend that they're being generous, or that they're doing it, like, you know, just to be nice, or I don't know.
Yeah, what you said there, one little piece in there about the different obligations, like the chain of custody of some of these assets, like a treasury can have between, I think the Fed came out with a study. It was like between 6 and 20 owners of that treasury.
And it's all collateralized, and it's all promised to every single one.
Yeah. And just imagine when the Fed, quote unquote, buys one of the treasuries off the market, they have to kind of collapse that whole chain, right? Because that treasury goes onto the Fed's balance sheet. And that's extremely, in my mind, that's extremely deflationary and retards the growth of the economy. So all of these policy, this monetary policy, fiscal policy, it actually handicaps the economy so it cannot grow in the future, right? And so you continually get diminishing marginal returns on all these things until something has to happen. And I guess the Fed, what I think is the Fed can kick the can to 0% growth. It can kick the can, maybe even slightly decline, like a 1% contraction for 20 years, just like Japan has done. Japan has been able to kick the can for 30 years. They buy up most of their the JGBs, and they buy up most of the stock market and stuff. But they've been able to kick the can for 30 years. And I think the Fed would be able to do that if it wasn't for Bitcoin, because Bitcoin gives that alternative to jump out of the system. What's your thoughts on that? Yeah,
no, I agree 100%. I think, like, so one of the things that has been interesting the past year is like the prevalence of like the money printer go burr meme. And that's like, I think it's very simplistic, but that's not actually what's happening. All of the stimulus, all of, you know, the printing of money, it's just more and more debt. And so ultimately that is deflationary, because it's going to have to be paid back. It feels inflationary because markets are up, everything's going up. It's more of the same. It's more credit expansion, but ultimately is that has to be repaid, and it's deflationary in the fact that, there's going to be, you know, the piper is going to have to be paid, which, you know, we'll see with these short-term cycles. So everything right now is on the way up. Real estate is on the way up. Bitcoin on the way up. It's all just a form of leverage. And so I think if the Fed keeps rates at zero, if they continue to inject hundreds of billions of dollars into the bond markets a month, with Bitcoin now there's monetary competition. So what you're seeing, Saylor says, all right, I'll call your bluff. I'm going to issue $1 billion in convertible notes. I'm going to buy Bitcoin at 0%. I'll give some equity optionality. So I'm not even paying interest for 7 years, and I can pay back $1 billion in 2027. And so, and MicroStrategy is a really small company, and $1 billion is like a drop in the bucket. It's nothing. But there's this reality that as more and more people and more institutions and entities hold Bitcoin on the asset side of their balance sheet, they also have dollar fiat liabilities. And so that in itself is a speculative attack where they're actively choosing to not pay down their liabilities and they're acquiring a monetary asset to hold. And so whether indirectly or directly, like Tesla would maybe be indirectly, where they acquire Bitcoin while they hold dollar liabilities. But with MicroStrategy and I mean, myself personally, other people I know, debt to acquire Bitcoin, it's really just an economic calculation. And like, am I going to pay, is Bitcoin going to appreciate more than 3% over the next, duration of your loan, or whatever the interest rate is in the duration? And if you think it is, then you acquire Bitcoin. And in this process, dollars are created because you're borrowing money. Lending creates dollars. And in the process, you're also taking Bitcoin off the market. And so I think that ultimately, and we're seeing it now with Bitcoin at 55,000, and I think we'll see it over the next decade with whatever the price is trading at, and whatever happens in the incumbent monetary system. If the Fed keeps rates at 0, or even if it were 3%, or even if it was, as long as there's continued easing and credit expansion, which there has to be, people are going to acquire this monetary asset that has no counterparty risk, that they can hold themselves, that can't be debased, and they're gonna use dollar or fiat obligations to do that. And so there's just this reality that monetary mediums are always in constant competition with each other, and that's an inescapable reality.
Dude, that's so well put. That's great, man. I can't believe you only found Bitcoin 2 years ago, because that was a really good summation of, I think, where the narrative for Bitcoin is headed. That people don't quite get that yet. I think that's even an expansion on the Saifedean's book, The Bitcoin Standard. I think what you just said there is, it's tying in the legit monetary policy that we see. I think Saifedean's book is a little bit more theoretical or ideological of what's going on, but that was really, really good. I wanted to take this into second order effects, because you take the story there, or your post there, about like social unrest and populism. What's your take on the current state of the United States? And maybe we could expand that to Europe in the West. And do you see war coming? Do you see, like, what kind of social unrest are you talking about?
Yeah, I think there's a large, like, a large percent of the population that has been hurt by this, this last really 40 years, but more specifically the last like 20 years or so of asset inflation. And it's really just, I guess, credit expansion, where these people, like most people, don't own any assets. And, like, I think there's some crazy stat, like 50 or 40% of Americans don't have a spare $1,000. And so there's just this reality that a majority, or like, I guess, like half the population only has dollars, and only, I guess, makes their living on a fixed wage. And so with all this asset inflation, with, I guess, CPI being stated, inflation and all this stuff being stated at 1 to 2% over the last decade. Meanwhile, like M2 money growth is at 10%. The equity markets are roaring. If you've just sat on a long bond over the past 10, 20 years, you've made a killing. Anyone that's held an asset, just real estate, like a lot of people, a lot of older people, or like boomers, or people that have a lot of real estate, specifically over the last 40 years, think that they've made it because they're a prudent or savvy investor, when it's just, the reality is that discount rates have gone from 20 to 0 over the past 4 decades. So the rich have basically gotten richer, and they've done that with just by continuing to lever up. And every time that there is this credit contraction, central banks and the Fed come in and basically give them some sort of a bailout. And not saying like that these people are bad or evil, just that's the reality, is that more and more wealth has been kind of just polarized into the hands of the few. And the people that don't have any assets are hurt. And a lot of times they don't know why they're hurt. So the rise of, increasing amounts of like Marxism, and I guess like democratic socialism, and I guess like far right, far left, all of this stuff, AOCs, Bernies, like these politicians that are rising in popularity. I think that's a second order effect of the wealth polarization that's taken place. Yeah.
Speaking of second order effects and, the effects on society, we're starting to see like the effects on individuals too, right? I think COVID has kind of presented a very unique case study where it's like almost like Weimar Germany, but everyone is stuck in their house and is getting some sort of like welfare piped into them. So they have no incentive to work. They don't have enough money to really change their lives. And a lot of people are incentivized to trade. My retired uncle who doesn't know shit about markets, and I would not trust for 1 second to invest any money in any sort of like strategic way, is asking me about stocks. And I'm like, dude, you need to not be messing around in this market. And guess what? I was wrong, because that was a freaking like 35% ago on the S&P. So like,
he bought Dogecoin.
I mean, it would have done well for him. He did. And to some degree, like literally anything that is not the dollar is a better asset to hold at this point. So I'm just kind of curious, like you talked more, big picture, like let's talk about like the individual implications of this. Like, we can talk about, Japan has been doing, no growth, no interest rates for 20 plus years, QE for 20 plus years. And like, what are the effects on the demographics there? Like, I just feel like the second, third order effects on this kind of policy, it can go real deep.
Yeah. I mean, like, other examples are like more millennials are living with their parents than like I don't even know the numbers off the top of my head, but like people are priced out of real estate. They're over their eyeballs in debt, and with student loans, which is just another, second order effect of perpetual credit expansion, right? Like, I also touched on this a tiny bit in the piece, and I couldn't go more into this. Like, there's an entire book on Jeff Booth's thesis, the technological deflation. But like, say education, the ease and access of education and information has gone basically to zero. Like, I guess just talking on this pod, like all the stuff that I've learned, I've bought in a couple books, and everything else has been free on Twitter and everything else. It's all there. But last year I was paying, tens of thousands of dollars for an education to learn economics, to learn at a university. And so there's just this kind of broken and perverse incentive structure that perpetual credit expansion, especially kind of when it's backed by a state monopoly, that will continue to just say, hey, like student loans, like, everyone needs an education, as technology is like, nope, yeah, all this stuff's free. Like, go on Sailor Academy, go here, go there. It's all out there. So I think like there's so many different examples of like the broken incentive structure, that a broken money or like maybe a mispriced money has. And it's definitely showing up all over the society.
So I think there's two directions that we can take this, but I want to insert a new idea into the conversation. Like the long-term debt cycle really seems to also map onto this idea of like the fourth turning pretty well. Have you like thought about this idea of the fourth turning and again, like, how that fits into where the money and where the debt cycle kind of like plays into that?
I haven't read the book. I've heard Brandon Quittem. I think I've listened to his article with Guy Swan on the Bitcoin Audible, and then I've heard him on a couple of podcasts. It's really interesting. I mean, there's definitely a lot of like things at play here that like I don't think I can all put together. There's so many different trends happening. We're definitely at some sort of inflection point in human history. With technology, monetary systems, just like also like the sovereign individual, where it's like, the agricultural age, the industrial age, the information age, like all of these things are happening at once. And if you look at it with like a 1-inch view, nothing makes sense. It's like pure chaos. But, if you kind of backtrack a little bit and look from above, it's like, whoa, a lot of things are changing all at once.
So, I agree. And I think it's going to be really interesting to like, okay, so we have this long-term debt cycle. We have this like let's call it a fourth turning. And then like maybe we have this super cycle where it's like the logic of violence because of cryptography and Bitcoin is changing. And that's all culminating to like right now. So I feel like there's a lot of forces that are going to project the world into a very different direction, into the future. And I'm kind of curious, like, what's your take, right? Like, there's going to be a transition process. There's probably going to be a light at the end of the tunnel. All of us think that Bitcoin is at the heart of all of that. Like, can you just talk about like at the end of this long-term debt cycle and into this Bitcoin future, like, what's on the horizon?
Yeah, I think a lot of it just comes down to basic incentives. So like at the end of a long-term debt cycle, policymakers are monetizing debt at increasing quantities, debasing the money supply. The incentive there is to protect your assets, to protect your purchasing power in something that can't be debased. So we're like in history, that's gold. But in today, we're seeing gold hasn't moved in a year. It's trading flat, and Bitcoin is up 600% or 700% or something like that over the past year. There's also, with the increasing, what's it called, the wealth gap. There's more and more calls for like some sort of wealth tax, right? Where eat the rich has grown a lot in popularity and sentiment. So what's the incentive there? The incentive there is, okay, I'm going to protect myself and I'm going to protect my wealth in cyberspace, where no one can take it, where there's no counterparty risk, where it can't be debased. I think that more and more people, it's still super early, but more and more people are going to realize that Bitcoin is there's really no alternative in terms of something that, where you want to park your wealth, where you want to park your value. It just all comes down to incentives. And so I think there's just like everything's really incentives. No one's better than your incentives. So with Bitcoin, it's just this natural, it's like the most pure form of economic incentives we've ever seen. The whole loop of hodlers, miners, just the whole network itself. So in a world that's just kind of crazy and there's so much entropy, Bitcoin is just this kind of thing that chugs along and is a result of basic human incentives.
All right, I think we set up the scene here real nicely, that we have these long-term debt cycles. We know what the central banks are doing in response to that. We know the effects of these cycles and the central bank actions on people, on society, and that Bitcoin is the answer. Now, I want to wrap it up. Last question is, where does the dam break first? If in a central bank, in a world of central bank competition or monetary convergence of things, with the US dollar being the world reserve currency, what breaks first? Do you think that there's going to be like a central bank in the Chinese central bank, the PBOC or the ECB, or where does the crisis happen first? And who adopts Bitcoin first? And do you have any thoughts on that in general?
I think that there's definitely going to be some sort of like there's a game theory there between nation states and central banks, where there's going to be a first mover, and I don't really know if I have a view on who that will be. Probably a smaller nation, I would say, but I think where the dam breaks is that there's 100 trillion, I don't know, maybe 200. There are hundreds of trillions of dollars in credit obligations, and that are dollar, euro, but mostly dollar denominated. And I think the holders of these contracts are going to realize, and I think they're already starting to realize it, that they're basically signing up to lose their purchasing power. And so I think that there's going to be a sell-off in credit markets, and rates are going to start to spike as maybe inflation picks up. And right now we're seeing inflation actually start to show up in the CPI gauge, and that's a lot of supply chain constraints and all of that. It's not just a result of more money, but it's definitely playing an effect. I think so. The bond market, in my view, sells off, and there starts to be some sort of deleveraging event as people kind of realize that, the risk-free rate of 1.5% on the 30-year treasury or whatever it is, I'm guaranteed to lose almost all my purchasing power. And so then the Fed, these central banks have a decision. They can basically monetize everything, like the yield curve control. Like QE is we're gonna put a fixed amount of money in. Like right now, it's like $120 billion a month, and then we're gonna buy at any price. Yield curve control, essentially, if they're committed to it, is we're gonna pump an undisclosed, and it doesn't really matter how much money, as much as it takes to pin yields, to pin bond prices at a certain point. So that's essentially, that's just challenging the market to really, that's saying, all right, well, we're a buyer at any price. And so if yields spike like this, as all these bondholders realize I'm going to get wiped out, I think what occurs is central banks, not wanting to be the one where everything, where it all collapses, basically monetize, like the Fed balance sheets at 7 trillion. I think that this decade we'll see it in the 20, 30, 40, 50 trillion dollar range. I mean, I think they're going to have to monetize nearly all of the sovereign debt markets. And they're going to, re-enter themselves in the corporate bond markets and all of this. And they're going to just monetize everything. And I think that's, that's where Bitcoin is trading in 7 figures. And that's kind of the transition. But that's just my guess. I really don't know. I'm stacking regardless.
Let's go. Always be stacking. I mean, that just statement, I feel like, encompasses what Bitcoin is that there's uncertainty about the future, and Bitcoin is certainty, and I'm just going to keep accumulating. So I feel like that trend is only going to strengthen. And hopefully, as we transition to a Bitcoin world, there can be some more certainty. There can be some better forecasting, because ultimately, this is just about, do humans have tools to measure and communicate value and ultimately make decisions on that? And I think that that's really where Bitcoin shines, and where the existing system is really faltering and crumbling. Dylan, this was an absolutely banger conversation. Ansel's DMing me right here. I can't believe that you're so young and you know all this stuff. Where can people learn more about you? Where can people find your work? And I guess if you have a last word for our audience, what would that be?
Yeah, thanks for having me on. It was awesome to come chat. You can find me on Twitter at BTCization, Bitcoinization. I work for Bitcoin Magazine doing some stuff covering markets and doing some on-chain analytics and whatnot. So yeah, just reach out over Twitter. Would love to have a chat. And yeah, I really appreciate you guys having me on.
All right, Dylan. Thanks again to all the listeners. Go follow Dylan on Twitter at BTCization. Go read all of his amazing articles at Bitcoin Magazine. Follow me on Twitter at CK_Snarks. Follow Bitcoin Magazine at Bitcoin Magazine. Follow Ansel over at Ansel Lindner. And what's your website? BTCMRKS.com.
Bitcoinandmarkets.com.
Oh man, I should know this by now. God, bitcoinandmarkets.com. Forget what I just said. And meet all three of us in Miami, y'all. Bitcoin 2021, best and biggest Bitcoin event in history. And yeah, you can meet us all there. So until then,
until next
catch you on the other side.
Peace.